Hi, my name's Scott Barnard. I'm a portfolio manager at Westwood on the multi-asset team. We wanted to spend a little time recapping March 2025 market performance and then also review our capital market outlook as we look ahead into April and beyond. Markets had a tough month in March. S&P was down from the first trading day and it was mostly downhill from there. As you can see looking at the chart, S&P was down 5.6% in the month, bringing year-to-date declines to 4.3%. NASDAQ 100 fared worse than the S&P, down 7.6%. Year-to-date declines now just north of 8%. And Russell 2000 or small cap stocks were some of the worst performers out there as well, down just about 7%, and year-to-date declines now almost down 10% on the year. This follows a really strong fourth quarter performance for small caps following the election of Donald Trump. Turning to the fixed income indices, fixed income returns were much more muted in March than the equities. The aggregate index was up 4 basis points. Corporate spreads widened modestly, posting negative returns with investment grade down 0.3%, high yield down 1%. If we look at the changes in bond yields, you can see kind of a twisting that's taken place. Front end yields have declined, the 2-year down 11 basis points, while 30-year rates were actually higher, up 8 basis points. 10-year was unchanged at 4.21% for the month. Looking at corporate bond spreads, you can see some of the widening that has taken place. Investment grade spreads have widened from 86 basis points to 93. The yield to worst has increased slightly as well. High yield spreads were even wider, increasing from 283 basis points to 345 basis points, bringing the yield to worst to 7.73%. Recapping some of the economic data during the month, a general theme was that soft data continued to come in weak, while hard data held up relatively strong. CPI and PPI both came out a little bit better than expected, but the details that feed into the Fed's favored metric of PCE inflation were slightly less favorable. Stagflation concerns are increasing, particularly in the face of increasing tariffs. A lot of the progress that has been made in reducing inflation has been made on the goods side, as opposed to services where inflation's been a little bit stickier. Tariffs will be a pressure point for this, as they will likely hit goods inflation much harder than they will services inflation. As mentioned, soft data was particularly weak in March. The best indicator of this is the University of Michigan data that showed declining consumer sentiment as well as expectations. At the same time, they showed inflation expectations increasing dramatically, with 1-year expectations up to 4.9% from 4.3% just the month prior. It's notable that this data is somewhat noisy, and take it with a grain of salt, but it's still worth highlighting and certainly caught the market's attention. In the middle of the month, FOMC met and announced no change to their target rate following their meeting on March 19th. They also released an updated summary of economic projections, which showed forecasts for GDP, inflation, and unemployment. The potential for stagflation crept into these forecasts as well. Real GDP is expected to be lower, core PCE is expected to be higher, and the unemployment rate is expected to increase. That said, they do still continue to expect to reduce interest rates later this year, implying that they believe the risks to unemployment are perhaps higher than the risks to inflation. Tariffs remain an overhang on the market. Uncertainty is increasing, and this could lead to lower economic activity simply as companies are paralyzed by the ever-changing environment and hesitant to make any large-scale decisions. It has the potential to spiral into what we would call a vicious cycle. Looking at equity performance in a little more detail, we can see some pretty large dispersions in sector performance. The consumer discretionary sector is particularly exposed to increased tariffs and the margin pressures that would result from that. You can see it down 9% on the month, bringing year-to-date declines to almost 14%. Information technology sector is sensitive to declining growth estimates. You see it down 9%, bringing year-to-date returns down just under 13%. Energy, on the other hand, had a strong month as crude oil prices ended the month higher. Utilities were also a relatively strong performer, given the defensive nature and the overall decline in interest rates. Now spending a few minutes on fixed income performance. Spreads were wider, total returns were mostly lower, particularly on the long end, given higher 30-year Treasury yields. Spread performance by sector was relatively similar, although we did see financial spreads increase a little bit more than both industrials and utilities. Another theme that we've seen is decompression, meaning lower quality credit spreads are increasing more than higher quality credit spreads. We're able to see this in the breakdown by credit rating, where you see double B corporate bond OAS was up 40 basis points, where triple Bs were only up 10 basis points, and single As were up 5 basis points. Now turning to our capital markets outlook. We updated this in early April following Donald Trump's announcements on Liberation Day of increased tariffs across virtually all of our trading partners. As a result, we have increased our probability of an economic slowdown. Our baseline expectation is now for lower but still positive GDP growth, higher core inflation, and higher unemployment, although we expect the unemployment rate to remain relatively contained at 4.4% by the end of 2025. Uncertainty is not good. Companies delay investments and consumers delay spending. This is bad for the economy. Financial conditions become tougher for companies with uncertainty and market volatility. Tariffs are like taxes, largely the same as a sales tax. Ideally, we get some offset from lower income and corporate taxes, but that will take time. We need to understand the end goal. Is our goal for tariffs to remain as a revenue generation in order to reduce the deficit? Or are they being threatened to force other nations to negotiate their tariffs down to zero? These are very different goals, and the market needs some clarity on this. Companies also need clarity. This uncertainty is not good for investment and is the biggest driver of our reduction in baseline expectations. Now turning to our asset class outlooks. We've made some adjustments here as well. We are now neutral on equities. We expect that some individual stocks will be oversold, which will provide opportunities for selection. Bank earnings will start shortly, and then many other companies will quickly follow. But ultimately, anything backwards looking is less valuable given all the ongoing changes in the economy. Our outlook for credit is negative. Default compensation remains too low. At the end of March, spreads were in the 18th percentile for investment grade and the 22nd for high yield. This means that if the economic downturn continues and defaults were to increase, spreads could go meaningfully wider. With regards to interest rates, we remain positive on duration exposure as both the safe haven and reflective of lower expected growth. There's been a lot of focus lately on international holdings of treasury bonds. Most recent data shows foreign holders now hold roughly 30% of the market, down from 50% roughly a decade ago. Japan is the largest, followed by China. We do not expect that these nations will choose to liquidate their holdings in short order, but we do expect that demand from this group will remain weak over the medium term. Now turning to our chart of the month. This chart shows estimated tariff rates following Liberation Day on April 2nd. It's reaching levels we haven't seen in over a century, above those following the Smoot-Hawley Act. This is obviously in flux. On April 9th, Donald Trump announced that country-specific tariffs have been paused for 90 days for those countries that haven't retaliated. China, on the other hand, saw their tariffs increase to 125%. In static terms, the average tariff rate does not change from this chart despite the dramatic change in country-specific tariffs. In practice, 120% tariffs are so punitive on Chinese goods that we expect Chinese imports to shrink dramatically. This will likely decrease the average effective tariff, but it will remain well above levels since at least the 1930s. Uncertainty remains a major headwind. The drag from trade policy is likely to be somewhat less than before these latest announcements, but we still see an increased risk of economic slowdown in the future. Thank you for your time. If you have any questions, please reach out to your advisor. We'd be happy to talk, and we look forward to speaking to you again next month.